Buy low, sell high is a terrible piece of advice for a trader or investor. If you want to actually make proper money with the stock market, you've got to do it differently, and I'll be discussing just that in this video. Hello everyone and welcome back to today's video. In this video, we're diving into the stock market and the strategy that I've discovered through my research and personal experience. Cost averaging into the stock market, specifically with the S&P 500. If you're looking for a way to build wealth over time without the stress of market timing, this video is for you. Because let's be fair, there's absolutely no way you can time the market. Not even Warren Buffett times the market. He studies companies' financials and decides whether it's a viable option to invest into or not for the long term. And yes, some of you traders do have indicators that may show the direction of the market, but yet even those you cannot time the market with. First, let's talk about what cost averaging is. Cost averaging, or dollar cost averaging, is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of the stock price or movement. This can be weekly, monthly, yearly, whatever suits you. Whether it's going downwards or upwards, you invest. The idea is that over time, you'll buy shares at various price points, which can average out to be more favorable compared to trying to time the market perfectly, and it is best done with something like an S&P 500 index fund. Now, why the S&P 500? The S&P 500 is an index that comprises the top 500 companies in the US, making it one of the safest and most reliable forms of stock investments. These companies are leaders in their industries and have a history of strong performance like Apple, Amazon, Microsoft, Meta, and so on. By investing in the S&P 500, you're essentially buying into the overall US economy and spreading your risk across multiple sectors, including tech, healthcare, real estate, energy, utilities, and much more. You're spreading your eggs and not going into one basket. Here are some key benefits of cost averaging into the S&P 500. Number one, it reduces the risk of market timing. You don't have to worry about buying at the wrong time because you're consistently investing regardless of market conditions, and over time, as you'll see on the chart displayed on the screen, when you zoom out, the S&P 500 has trended upwards time and time again. After every major event, there was a dip which showed to be a great buying opportunity, just like COVID, world wars, and you name it. And it trended upwards again, reaching all-time highs. Number two, emotional discipline. It helps you avoid emotional decisions based on market volatility, especially when you zoom out. The volatility, 2 to 3% market movement in a day, won't affect your decision-making process. What would also help is if you have an auto trade set up where every 1st or 5th of the month, a specific amount of your money from your bank account is invested into the stock market without you having to view the charts. This way, you're completely detached and unaware of market conditions. Number three, compounding returns. Over time, your investments can grow significantly due to the power of compounding. This is where generational wealth is made. The compounding effect is what has made people their millions and billions, and Warren Buffett, who is a legend in the stock market investments, has built his wealth just like this. He made his first $1 billion at the age of 56, and within just the next 10 years, he made an additional $16 billion. That's the beauty of compounding. Another bonus tip to grow this compounding effect is to invest in mutual funds or exchange-traded funds, or ETFs in short, that track the S&P 500 index. These ETFs end up paying dividends on a quarterly basis, which helps you earn some additional cash while your cash is being invested in these companies. And then you can reinvest that dividend back into the market. So you're making your money work for you. Number four, lower costs. By investing regularly, you can potentially lower the average cost of your investments over time. So how do you get started with this strategy? Here's a simple step-by-step guide. Number one, open a brokerage account. Choose a reputable brokerage that offers low fees and the ability to purchase index funds or ETFs that track the S&P 500. If you're in the UAE, I will link my previous video up on the screen or down in the description box below, where I recommended a few brokerages myself. Even international viewers can use these. Number 2, set up automatic investments just like I mentioned before. Decide on a fixed amount you can comfortably invest each month and set up automatic investments. I tend to invest around 20% of whatever I make that month, which is what I'm comfortable with losing if shit hits the fan. Next, stay consistent. Regardless of market ups and downs, keep investing that same amount every month. Close your eyes on it. Next up, monitor. Don't micromanage your portfolio. Keep an eye on your investments, but don't get caught up in daily market fluctuations. Remember, this is a long-term strategy, not a quick cash, get-rich-quick scheme. Let me give you a real-life example. Suppose you decide to invest $500 every month into an S&P 500 ETF. Some months the market will be up and your $500 will buy you fewer shares. Other months the market will be down and your $500 will buy you more shares. Over time, these fluctuations average out and you benefit from the long-term growth of the market. Patience is key in this strategy. Historically, the S&P 500 has provided an average annual return of around 7 to 10% after inflation. By staying invested and consistently adding to your portfolio, you give your investments time to grow and benefit from the market's overall upward trend. It's pretty much just like property return on investment. In conclusion, while buy low, sell high sounds good in theory, it's incredibly hard to execute in practice. By adopting a cost averaging strategy and investing in a broad index like the S&P 500, you can build wealth steadily and reduce the stress associated with market timing. It is a disciplined, patient approach that has proven to work over the long run, time and time again. So with that being said, this brings us to the end of today's video. What do you think about this strategy? Have you tried cost averaging before, or are you considering it now? Let me know in the comments section below. And don't forget to like, comment, subscribe for more videos just like this one. See you guys in the next one.